In the year 2018, the lights finally went out on one of the largest retail empires in American history. This map tracks the final liquidation. Across the United States, all 735 remaining Toys R Us retail locations simultaneously shut their doors for good. To understand the sheer magnitude of this collapse, we have to look back to 1994, when the company hit its absolute peak, generating $8.7 billion in annual sales. At that time, they commanded 25.4% of the entire American toy market. 1 out of every 4 toy purchases happened under their roof. The Standard Business obituary blames this demise entirely on the internet, specifically the rise of Amazon and the shift to e-commerce. But the actual autopsy reveals a much different pathology. The collapse was triggered by a disastrous decision to outsource its digital operations, and it was made fatal by a highly engineered leveraged buyout. A toxic capital structure systematically dismantled the company, draining its cash reserves and suffocating its ability to adapt to a shifting market. The origin of this empire dates back to 1948, when Charles Lazarus opened a shop in Washington, D.C., focusing on baby furniture for post-war families. During this era, selling toys was a notoriously difficult business. Traditional department stores controlled the market, but they treated toys as a seasonal commodity, cramming all their inventory and sales into a narrow 6-week holiday window. Lazarus bypassed the department store model entirely by applying the logistics of a self-service grocery supermarket directly to the specialty toy category. This diagram compares a standard department store toy section to the new Toys R Us format. Lazarus expanded the footprint into a standardized 45,000 square foot warehouse layout. Filling that massive space with tightly packed aisles, they stocked 18,000 unique items year-round. By decoupling toy sales from the December rush, Toys R Us rewrote the retail supply chain and established the original blueprint for what we now call a category killer. After taking the company public in 1978, this operational scale triggered a massive acceleration. Throughout the early 1980s, sales surged by 185%. By 1983, the retailer crossed a major financial threshold, breaking $1.3 billion in annual sales. This sheer size created a self-reinforcing competitive advantage. Because they purchased inventory in such massive volumes, Toys R Us negotiated deep supplier discounts that local mom-and-pop stores simply could not match. This volume-driven growth compounded for decades, eventually reaching that $8.7 billion revenue peak in 1994. Controlling that much volume meant the retailer held ultimate leverage over the entire industry. They possessed the power to dictate exact manufacturing runs and packaging dimensions directly to global toy suppliers. In the late 1990s, the first major structural fracture appeared. Big box discount chains aggressively entered the toy space. Retailers like Walmart and Target adopted a loss leader strategy. They deliberately slashed prices on popular toys to near-zero margins, using them as bait to drive foot traffic for higher-margin goods like groceries and clothing. Because Toys R Us relied exclusively on the margins generated by toys, they could not sustain a race to the bottom on price. This chart plots the exact moment the market shifted. In 1998, Toys R Us market share plummeted from a 25.4% peak down to 16.8%, just as Walmart's line climbed past them to 17.4%, usurping the #1 position. Reacting to this loss of dominance, the company made a disastrous digital pivot in August 2000. They signed a 10-year agreement, paying $50 million a year to completely outsource their online operations. In practice, this meant any customer typing toysrus.com into their browser was seamlessly redirected into Amazon's fulfillment ecosystem. Amazon utilized the exclusive inventory data generated by Toys R Us searches to learn the mechanics of the toy market. Once they understood the demand, Amazon began inviting competing toy sellers directly into their marketplace. Toys R Us sued for breach of contract and won a $51 million settlement in 2004, allowing them to terminate the agreement early. Despite the legal victory, outsourcing their digital real estate was a fatal strategic error. It cost the retailer a critical decade of internal e-commerce development right as the internet was becoming the dominant retail battleground. Already losing ground to big box stores and lagging in e-commerce, the company pivoted to private equity in 2005, executing a massive $6.6 billion buyout. The transaction was executed by a consortium of three heavyweights: Bain Capital, KKR, and Vornader Realty Trust. To understand how this destroyed the company, we have to look at the exact mechanics of a leveraged buyout. The transaction began with the consortium assuming $2.3 billion in existing company debt. To finance the purchase, buyers stacked $4.4 billion in new debt onto existing obligations, creating a $6.7 billion debt structure. This pushed net leverage to a fatal 7.0 times multiple of adjusted EBITDA. The most dangerous element of this new pile of obligations was that $1.9 billion unsecured bridge facility. Operating at a 7.0 times leverage ratio meant that almost every dollar of profit was already spoken for. It entirely eliminated the company's financial margin for error in an increasingly cutthroat retail sector. Immediately following the buyout, a severe macroeconomic headwind struck. Global interest rates began to rise. By 2006, the 12-month LIBOR rate, a benchmark for short-term interest rates, hit a peak of 5.69%. This animation shows the direct mathematical impact on that $1.9 billion bridge facility. Because the loan was structured at LIBOR plus 5.25%, the rising rates pushed the total interest rate to a punishing 10.94%. This triggered a staggering ongoing cost. Over the next 12 years, Toys R Us was forced to make average cash interest payments of between $400 and $467 million annually. To contextualize that burden, servicing the debt alone consumed nearly 3.63% of the company's total net sales every single year. This massive mandatory cash outflow directly starved the company of the capital expenditures it desperately needed to fight Walmart's price war. This ledger visualizes that operational strangulation. When you subtract the $467 million interest expense directly from the operating revenue, it leaves exactly $0 available for necessary capital expenditure. The empire was now caught in a lethal triad. Their margins were compressed by big box discounters, their digital infrastructure had been ceded to a competitor, and they were crushed under the weight of leveraged debt. Without free cash flow, specific operational upgrades became impossible. They could not renovate their aging 1980s-era physical stores, and they could not update their archaic inventory tracking systems. The final casualty of the debt burden was the absolute inability to properly fund and relaunch a modern e-commerce platform to win back digital share. Toys R Us collapsed because its capital structure was optimized to extract private equity returns, prioritizing short-term financial engineering over the company's long-term corporate survival.